Hi folks, welcome to this video on setting up the allowance for doubtful accounts, or as we say, the allowance for uncollectible accounts. And here we're going to discuss one of the two methods known as the percentage of credit sales method. So this is a question that some of you may have seen before. It says the company started business on January the 1st of the current year. They made total sales of $900,000 and only $150,000 were for cash, so the other $750,000 were on credit. We're going to use the amount of that credit sales to help us set up the allowance, but we'll talk about that in a couple of minutes. Now it says by the end of the year, the company did receive payments from their customers of $675,000, and again, that $675,000 was from customers who they had sold to on credit or on account. They wrote off $10,000 as uncollectible. So those are customers that had filed for bankruptcy, so they didn't think they were going to collect. So that was the only amount that the company had related to bad debts for the period. The company uses the allowance method of accounting for bad debts, which we know is the appropriate way to handle any accounts that are unlikely of collection. And the reason we say that is because we want to state our accounts receivable at net, their net carrying value, or net realizable value, meaning the amount that we think we can reasonably collect from our customers. Dundee's a new credit company. It has no past experiences upon which to base its own estimates on. So they use the industry standard of 3% in order to set up their allowance and the amount unlikely of expense for bad debts. And what they want us to do is to find the amount of bad debt expense that we're going to report on the income statement, make the write-off entry in Part B, say what the allowance balance would be on the statement of financial position or balance sheet at the end of the year. They want to know how we would present the account receivable balance, at the end of the year. And let's talk a little bit about the reasonableness about what the company has in the allowance account at the end of the year. So let's begin to look at the data in the question and put together the solution. So the first thing we're going to do is calculate the amount of bad debt expense. Well, the bad debt expense, if we look at the solution here, is going to be based on the percentage of credit sales. Well, don't forget, the question told us how much we sold on account, and that 150,000, or how much we sold in total, but that 150 of that was a cash sale or cash sales. So we know our credit sales must have been the difference. So that's 22,500. Now, the question didn't ask us actually to set up the journal entry, but if we were to do that, we would debit the bad debt expense for 22,500, and we would credit the allowance for doubtful accounts. We would credit that. Let me just see if I can bring this guy back here a bit. We credit the allowance for. Now, the question didn't ask us to do that, but I always think it's a good idea because this is the entry that would establish the balance in the allowance. And I'm saying it establishes it because for this particular company, this is the first year they've been in business. They've never had to set up a bad debt expense before, so they don't have an allowance. So this actually establishes the balance in the account. So now you can see we have 22,500, and we need to write off 10,000 against that account. So I look at the allowance as the safety net. It tells us how much we have to have in reserve in order to write off accounts unlikely of collection. And we did have a write-off. We had a write-off of 10,000. So we're going to dip into that little safety net and debit it by 10,000 and credit the receivable. So by crediting the receivable, it tells us that at the point in time in write-off, we didn't think we were going to collect it. And that makes sense because we were told the customer was filing for bankruptcy. We figured we wouldn't get anything, right? So we're not going to keep something in account receivable because an account receivable is an amount in an account that says we're waiting to receive that amount from customers. Well, you're not if they filed for bankruptcy. So you take it out of the receivable and you write it off against the allowance. So the allowance is a normal credit balance. So to write off against it, we debit it. So now, how much is in the allowance for doubtful accounts? Well, at net we have $10,000. We set up $22,500. We can see that in our journal entry, and we wrote off $10,000. We wrote off $10,000 here. So that means that we have $12,500 at net there. Okay, folks, let's resume our video. I don't know if you noticed that, but the reason I paused the video there for a moment was that I noticed that the allowance account, they had the wrong number down here. They had a $10,000 amount. So let's just make sure that we understand this part here. The question asked you, we'll just flip that back up. The question asked you to determine what the allowance account balance would be on the statement of financial position at the year end. So in our question, if the allowance started at $22,500 and we wrote off $10,000 against it, that means we'd have a credit balance of $12,500. So that's why we've got brackets around it to show it's a credit. And then we showed you here what the T account would look like. You had a $22,500 credit, all right, in the allowance, and you wrote off $10,000 against that. So that would be $12,500 left in there. Now, one of the questions I sometimes get from students when they look at the T account is, at what time are these entries being made in the accounts? At what time do we make these entries that I'm highlighting here? That's a really good question because I'm going to kind of answer it and say it depends. You can see here that this entry up here that sets up the allowance, and again, it wasn't required in our question, but it gives us an opportunity to teach here. You'll notice here that it's an entry that can be made at any point in time. It could be that this company said, well, you know what, we're going to set this up, the allowance up, at the end of the quarter. I consider it to be an adjusting entry. So in other words, we might set it up at the end of a quarter, at the end of a 6-month period, or at the end of the year, whatever have you, right? But all we know is that whatever we set up in this allowance, during the year, we wrote off $10,000 against it. So normally what we would do is if we hadn't set it up yet to write anything off against it, we might set it up based on the information that we have because it's based on credit sales, and credit sales occur for a period of time. So we don't know when this $900,000 occurred. We are the total sales, and of those total $900,000 in sales, when the credit sales happen, we just know it's for the year. So technically, we don't know when this entry was made. It could have been made halfway through the year or at the end of the year. But the bottom line is we're going to write off against it. And that's going to leave us a $12,500 credit balance. All right? So what's the gross amount of the receivable that's left? Well, in our question, this is in part D now that we're doing. In our question, we know that we had $900,000 in sales during the year, of which $150,000 were cash. So of the $750,000 in credit sales, we know we collected $675,000 throughout the period, throughout the year. So don't forget, we had this $10,000 write-off as well. You remember this entry from back here, and that reduced your receivable. So that means we have $65,000 left in the account receivable at gross. So gross means before write-off. But during the year, we wrote off $10,500, which left us with $12,500. That's our balance here, or from our T account. So that means the net account receivable. So our account receivable at what I would call its carrying value, or net realizable value. Net realizable value is the amount that we think realistically we're going to be able to collect from those customers who have still not yet paid us. That's $52,500. So if you were tracking what was going on in your accounts receivable account, you'll know it started at $750,000, not $900,000, because don't forget the $900,000 was what you sold in total. Only $750,000 of that was sold on account. You collected 675,000 of it during the year, and you wrote off 10. So that tells us there that at net you had in your receivable 675 less your 52.5, and that's less your 12.5, and that's going to give you at net this amount here, a 52.5, which is your net account receivable, or your account receivable at its net realizable value, or what we say carrying value. So now the last part of the question asks us to consider whether or not the amount that's in the allowance is reasonable. So remember, in our question, it says to evaluate the reasonableness of what's in the allowance for doubtful accounts at the end of the year. So again, this gives us another opportunity to teach, because it says here the balance might not be reasonable if the collectability of the receivables is not yet reflective of industry. And why they're saying that is because, don't forget, you set up the allowance based on what the industry was using, which is 3%. We don't know what's reasonable for you. You might have very, very lenient credit granting policies, which means you might have a higher amount that you don't collect, right? Uncollectible. So you might not be too strict with your customers. It could also work the other way. You might be much stricter with your customers than other competitors in your industry, so you may find 3% is high for you. So it depends. It might not be enough. It might be too much to set up 3% depending on your credit granting policies, right? Now it says here, instead, basing the allowance account balance on specific customer balances that are overdue, or using an aging schedule, which is another method we talked about, using the balance sheet or the aging approach. An aging analysis might be a better valuation of accounts receivable. So the reason why I highlight this is because we may find some companies use the percentage of credit sales during the year, maybe to set up their allowance account, or to adjust it at the end of a quarter or the end of every 6 months based on credit sales for that period of time. Because don't forget, credit sales are for a period of time. That's an income statement or statement of earnings account, right? So that's, just what happens within the year. But if we're doing our final financial statements for the entire year, and we're doing our balance sheet or statement of financial position at the end of the year, our best bet to get a more accurate read on what we should be putting in that allowance would be probably to use an aging schedule. So what some companies do is they might use the percentage of credit sales just during the year for internal accounting reporting purposes, but then at the end of the year they may turn around and say, well, I need a more exact number. I'm going to look to what my customers have not yet paid me and get a feel for how much of that I think I'm still not going to be able to collect, and set up my allowance like that. So again, this statement here is very telling, because a lot of companies use a percentage of credit sales throughout the year, but when they need to finalize their balance sheet and what they're going to put on it, they might use the aging schedule to get a more accurate number. Okay, so, and they make a comment here that establishing an allowance is very difficult if you're only in your first year of operations. Yeah, because we'd rather you do it on your own history, your own collections history, or what's not collected, based on your own policies and your own efforts, right? But in this case, we didn't have it because the company was only in their first year of business. So we would be looking over time to see if this 3% is reasonable, and then adjust it as we feel is appropriate. So that concludes our little video on this question. I hope you found it helpful.